right now, I mean, the tech industry is spending roughly $600 billion dollars a year just building the physical infrastructure for artificial intelligence. But do you know how much they are actually making from it?
Yeah, it's not even close to that number.
Not even close.
Yeah.
Like, behind all the public hype about a utopian future where AI just does all our work for us, there is absolute panic on Wall Street.
Oh, complete panic.
Right. There is this very present, very massive black hole where all the money should be.
We are looking at, honestly, one of the most extreme financial disconnects in modern economic history.
Wow.
Yeah, the gap between what is being spent to build these systems and what customers are, actually paying to use them, it's widening every single day.
And that black hole, that is our mission for today. We are cutting through all the generic tech hype to look at the cold, hard math.
Which is pretty staggering when you look at it.
It really is. So for this deep dive, we've pulled together a whole stack of reports from heavyweight financial and tech media. We're talking Goldman Sachs, the Financial Times, The Economist, The Information, just to unpack this structural crisis that is literally keeping tech executives awake at night.
Right. And if you want to understand the tech economy right now, you really have to understand
Okay.
the core term that's dominating all these financial reports.
Which is?
The AI ROI gap, return on investment gap. You also see it called the AI revenue gap.
Okay, so let's be super clear with you listening right now. This is not a deep dive claiming that AI is like a fake technology or that the models aren't doing incredible things.
No, the underlying technology is incredibly powerful.
Right, it is. But this is about the money. We are looking at a situation where the technological build-out has completely detached from commercial reality.
Totally detached.
So to understand this gap, we have to look at the physical reality of what is actually being built. Like, where is the $600 billion actually going? Because it's not just paying software engineers to sit in a coffee shop and write code.
No, not at all. The spending side of this equation is what the financial world calls CapEx.
Capital expenditure.
Exactly.
Yeah.
And we are witnessing this massive CapEx boom driven by the major hyperscalers. So, Microsoft, Google, Meta, Amazon.
The big guys.
Right. They are pouring hundreds of billions of dollars into physical, heavy industrial infrastructure.
Like, we're talking concrete, steel, massive cooling towers.
Yes, because training and running a massive large language model, it's not like running a traditional piece of software.
How so?
Well, think about a standard Google search. It pulls from an index database, right? It's cheap, it's fast, but generating a custom AI response requires massive parallel processing.
It has to think on the spot.
Exactly. It basically forces thousands of these highly specialized GPUs, like Nvidia's H100 chips, to do incredibly complex math simultaneously.
Mm.
And that requires an astonishing amount of electricity.
So they aren't just like buying some extra servers for a server room. They are having to build entirely new power substations just to keep the lights on.
Oh, they are retrofitting the power grid.
Seriously?
Yeah, they're signing nuclear power contracts. They're building liquid cooling systems because these GPU clusters run so hot that they would literally melt a standard data center.
Melt it.
Literally melt the racks. It is a monumental physical build-out. And that brings us to the math from Sequoia Capital, which is one of the top venture capital firms in the world.
Right. They're the ones who calculated the actual cost of this global CapEx boom.
Yes. They sat down and ran the numbers.
And this is where that $600 billion figure comes from. How exactly do they get to a number that massive?
Well, it's kind of a cascading math problem.
Yeah.
So Sequoia looked at Nvidia's revenue, which is essentially the baseline cost of the hardware that everyone is buying.
Okay, the chips themselves.
Right. But for every dollar a company spends on an Nvidia GPU, they have to spend roughly another dollar on the energy, the data center space, and the cooling to actually run it.
Which doubles the cost right there.
Exactly. Then the hyperscaler, so the cloud provider hosting those GPUs, they need to make a profit margin on top of that physical cost.
Makes sense.
And finally, the AI software startup that rents that cloud space, they need to make a margin when they eventually sell their app to an end user.
Right. Everyone needs their cut.
Exactly. So by the time you multiply the hardware costs by the energy costs, and then you layer on the required profit margins for everyone in that supply chain, the industry needs to generate $600 billion in real end-user revenue every single year just to break even on the infrastructure they are building today.
Every year.
Every single year, just to break even.
Okay, but wait. I mean, didn't Amazon lose money for over a decade building out its warehouse and logistics empire? And didn't Uber, burn billions subsidizing rides? Isn't this just the standard Silicon Valley playbook? Like, build the massive railroad first, run at a loss for a bit, and then capture the market later.
The railroad is actually the perfect analogy to see why this is so different.
Oh, so?
Because when you build a railroad, even if you are heavily in debt, you immediately start carrying high-value freight. Like, the utility is obvious right away.
Okay.
The problem with the current AI build-out is that we're spending hundreds of billions building a massive, state-of-the-art 10-lane high-speed rail network across the entire globe.
But right now, the only people paying tolls are a handful of people riding bicycles on it.
Exactly. Just bicycles on a superhighway.
Because the actual commercial revenue, like what everyday businesses and consumers are paying for ChatGPT Plus or enterprise AI add-ons, it's a tiny, tiny fraction of that $600 billion.
The shortfall is staggering. I mean, it's triggering what Wall Street analysts are now calling the CapEx reckoning.
The CapEx reckoning sounds ominous.
It is for tech executives. Investors are currently tolerating this insane spending because they have FOMO.
Fear of missing out on the AI revolution.
Right. But the reckoning is that inevitable day when shareholders look at the balance sheets, see these massive capital expenditures just dragging down profit margins, and demand that tech CEOs explain exactly when these GPU clusters will actually become profitable.
Okay, let's unpack this a bit more. If the tech is as revolutionary as passing the bar exam or, coding entire websites implies, why aren't businesses throwing money at it?
That's the $600 billion question.
Right. If I'm a CEO and this technology can theoretically replace half my administrative overhead, I should be paying whatever it takes to get that in my office. Why aren't enterprises bridging this revenue gap?
Well, because of a phenomenon analysts are calling the AI productivity paradox.
Okay, explain that.
So, on paper, these models are brilliant. They can do amazing things. But when you try to integrate them into a messy, real-world corporate environment, the utility just kind of breaks down.
But every company is bragging about buying AI tools right now. I mean,
Right.
You can't listen to an earnings call without hearing Copilot or generative AI like 5 times.
Oh, they are definitely buying the licenses, yes. But look at how it's actually being used by the employees. It's stuck in what we call edge scenarios.
That scenario.
Yeah, like it's being used to summarize a long PDF or maybe draft a polite rejection email.
Basically parlor tricks.
Right, convenient parlor tricks.
Yeah.
But businesses aren't seeing the massive cost reductions or the workforce restructuring that justifies a multi-million-dollar enterprise AI contract.
I see.
The unit economics of the software have just completely changed.
Right, because traditional software is a one-time development cost. Like, you build Microsoft Excel once, and selling the millionth copy costs you virtually nothing. The margins are incredible.
Exactly.
But with generative AI, every single time an employee asks the AI to rewrite an email, it burns expensive GPU compute and electricity. The variable costs never go to zero.
Never. And the return on that compute cost is highly questionable, which honestly, this is where we hit the most relatable part of this entire crisis.
Okay, I'm ready.
There's a new vocabulary term popping up in these financial reports to describe the day-to-day reality of using enterprise AI.
What is it?
It's called work slop.
Work slop. Oh, I love that term.
Isn't it great?
It perfectly captures that specific feeling of exhaustion when you're dealing with AI-generated content. Just slop.
Yeah, work slop is basically the hidden productivity tax of automation.
Okay, how does it work in practice?
It's what happens when employees spend more time managing, auditing, and fixing AI output than they would have spent just doing the task themselves in the first place.
Oh man, so here's where it gets really interesting. Think about a specific scenario for you listening. Let's say a marketing department buys an expensive AI tool to automate their weekly newsletters, right?
Classic use case.
The AI can instantly generate 5 pages of copy. But the AI consistently hallucinates a few key product features, and it uses this bizarre, generic corporate tone.
We all know that tone.
Right. Now, instead of just writing the newsletter, a human employee has to sit there, fact-check every single claim, rewrite all the weird phrasing, and ensure the AI didn't accidentally promise a refund policy that doesn't actually exist.
And you haven't saved any time in that scenario.
Yeah.
You've just shifted the human labor from creation to auditing.
Yes.
And the thing is, humans are notoriously bad at auditing automated systems. We just get fatigued. We glaze over.
So if an everyday employee is just fighting work slop all day, the tool isn't a productivity booster. It's actively draining their energy. It's a productivity tax.
Exactly. Which points straight back to the heart of the CapEx reckoning.
How so?
Because right now, companies are paying, say, $30 a month per user for these enterprise AI add-ons.
Right.
But when CFOs eventually run audits and realize their employees are just generating work slop and that the company hasn't actually saved any money or reduced headcount,
They're going to pull the plug.
exactly, those enterprise subscriptions are going to get canceled.
But hold on. This brings up a massive contradiction in the data that I'm seeing.
What's that?
If the enterprise revenue is really that weak and end users are just drowning in work slop, how are these AI startups getting these astronomical $50 billion valuations?
Yeah.
Because I see headlines every week about some AI startup raising billions and reporting massive immediate revenue. If everyday businesses aren't paying for this stuff at scale, where is all that cash flow actually coming from?
Okay, this is the most critical and frankly the most concerning mechanism in the entire AI economy right now.
Okay.
Financial media is calling it circular financing.
Circular financing. Walk me through the mechanics of this. How does the money actually move?
Well, it's basically a closed-loop accounting trick.
Yeah.
The major tech giants, the hyperscalers who own the cloud platforms, they invest massive amounts of venture capital into a promising new AI startup.
Right, which happens all the time.
Yet, let's say they give the startup $1 billion in funding. But there is a string attached. The AI startup needs immense computing power to train their new models, right?
They need GPUs.
Exactly. So, as part of the deal, the startup takes that $1 billion and immediately signs a contract to buy cloud computing services and rent GPUs from the exact same tech giant that just funded them.
Wait, isn't that just a massive internal transfer?
That's exactly what it is.
That's like giving your kid a $20 allowance with the strict condition that they have to use it to buy lemonade from your own lemonade stand, and then you brag to the neighborhood about your incredible lemonade sale.
Yes, that is the exact financial mechanism at play here.
That's insane.
Because here's why they do it. Wall Street values these tech giants based heavily on the growth of their cloud computing division.
Oh, I see.
Right, so by funding the startup, the tech giant forces the startup to buy their cloud services. The tech giant then gets on their quarterly earnings call and reports that $1 billion as cloud revenue.
That is wild. It artificially inflates the hyperscaler's stock price by manufacturing fake demand for their own servers.
It creates an illusion of a booming market. It makes the AI sector look incredibly active and lucrative.
Yeah, everyone looks like a winner.
Startups look highly valued because they raised $1 billion, and tech giants look unstoppable because their cloud revenue is surging.
But it's not real demand.
No, and the financial reports point out the fundamental fragility here. It is a self-watering garden.
Because no new money is actually entering the system from the outside.
Exactly. This raises an important question, right? You can only pass the same venture capital dollar back and forth between a tech giant and a startup so many times.
Eventually, there's no money left to pass.
Right. Eventually, for the industry to survive, the terminal market, meaning you, the listener, or a logistics company, or a hospital network, has to step in and inject real external money into this ecosystem.
We have to actually buy the software.
You have to buy it and find it useful enough to keep paying for it. If the end user doesn't step up, this internal transfer system faces a severe liquidity crisis.
It's going to run out of cash.
Exactly.
So the music has to stop eventually. The hyperscalers can't fund the startups forever just to buy their own servers.
No, they can't.
So when the circular financing dries up and the CFOs cancel their enterprise subscriptions because of work slop, what does the fallout actually look like? Are we talking about like a localized tech recession?
We are talking about what analysts call AI Winter 2.0.
Okay, I know the history of AI has gone through several winters over the decades.
Right, the periods where funding completely vanished and research just stalled out.
Yeah, but usually those winters happen because the technology hit a wall. Like it literally couldn't do what the scientists promised it would.
Exactly.
That's not the case here, right? The models are getting smarter. They can generate like photorealistic video from a text prompt now.
And that is the defining difference of AI Winter 2.0. The media outlets are warning that this time, it is not a failure of the technology itself.
It's not.
No, it's a commercial failure. It is entirely driven by that ROI gap. If the industry cannot find a way to generate that $600 billion in real commercial value, capital will violently withdraw, regardless of how impressive the tech actually is.
Wow. So, what are the early indicators we should be looking for? How do we know if we are tipping into an AI winter?
You watch the infrastructure layer. You look for startups suddenly failing to raise their Series B or Series C funding rounds because the hyperscalers stop subsidizing them.
Okay, what else?
You look for a sudden drop in cloud consumption. But most importantly, you watch the hardware orders.
The chips.
Yes. When the major tech giants quietly delay or cancel their orders for the next generation of Nvidia chips, that is the canary in the coal mine.
Because it means they've realized the commercial demand isn't there to justify the CapEx. So it's not that we wake up one day and ChatGPT just stops working. It's that we wake up one day and realize nobody can afford to keep the server farms turned on.
Because the cost of electricity and hardware vastly outpaces the value of the answers the AI is giving us.
That is a terrifying thought for Wall Street.
It is. If we connect this to the bigger picture, an AI winter 2.0 doesn't mean AI is a fraud. It simply exposes the immense risk of sinking hundreds of billions of dollars into advanced technology when commercial monetization is lagging dangerously far behind.
Right.
It's like building a massive, sprawling city designed for millions of people and then realizing only a few thousand have moved in, and they were struggling to pay the rent.
Wow. So what does this all mean for you navigating this tech landscape? Next time you read a headline about a massive billion-dollar AI funding round or, you hear a tech CEO promising that AI will double productivity by next quarter, look past the hype.
Definitely look past it.
Ask yourself, is this real revenue coming from external users who are finding actual bottom line value? Or is it just more circular financing?
Are we looking at a genuine paradigm shift? Or just tech giants trading allowance money at the lemonade stand to keep their stock prices up?
It really requires a fundamental shift in how we evaluate technology, doesn't it?
Absolutely. For the past 2 years, we've been completely obsessed with the capabilities of the models.
Like how many parameters they have or what standardized tests they can pass.
Right. But capability does not equal a viable business model. The gap between what is technologically possible and what is commercially profitable is the defining story of this era.
And understanding that AI ROI gap is your ultimate shortcut to seeing the tech economy clearly. You can't understand where this industry is going unless you understand the massive financial gravity pulling at it from beneath.
The structural imbalance is simply too large to ignore anymore. When you have $600 billion on one side of the scale and, edge scenario parlor tricks on the other, something eventually has to break.
And as we wrap up this deep dive, I want to leave you with a final thought to mull over. Our sources make it clear that bridging this enormous financial gap relies on human end users and human-run enterprises finally paying for killer applications, right?
Right, rather than just drowning in work slop and canceling their subscriptions.
But what if the ultimate solution to the ROI gap isn't forcing human workers to be more productive with AI tools at all?
Wait, what do you mean? That is a very different way to look at the CapEx build-out.
Think about it. What if the only way these tech giants can justify a $600 billion infrastructure spend is if AI agents eventually become autonomous economic actors themselves?
Oh, wow.
What if the AI isn't the tool the employee uses, but the AI actually becomes the employee?
Earning its own keep.
Exactly. Managing its own budget and effectively becoming the very customer paying the toll on that multi-billion-dollar superhighway.
That's kind of wild to think about.
If humans can't generate enough value to pay for the compute, maybe the machines will have to pay for it themselves. It's just something to think about the next time you audit an AI's hallucinated email draft. Thank you for joining us on this deep dive. Keep questioning the hype, look for the real ROI, and we'll catch you next time.